Are taxes a tool for fairness or simply a burden on the wealthy? Today we'll delve into one of the most debated tax topics, unrealized capital gains. You might wonder, what are these and why are they so controversial? Stick around and I promise we'll clear up all the misconceptions and arguments surrounding this topic. Most of us think of taxes as something we pay when we earn money or make a sale. But the richest among us can increase their wealth without paying a penny in taxes, thanks to something called unrealized capital gains. This strategy has led to heated debates, particularly when it comes to whether we should tax these gains. On one side, proponents argue it's a matter of fairness and equity. On the other side, opponents warn of economic inefficiency and administrative nightmares. So, who's right? Let's dive in. First things first, what exactly are unrealized capital gains? In simple terms, if you own an asset like a stock or a piece of real estate and its value goes up, you've made a gain. But if you don't sell it, this gain is unrealized. Think of it as counting your chickens before they hatch. For example, imagine you bought shares in a tech company for $10,000. Over the years, the value of these shares increases to $50,000. You've made a $40,000 gain, but until you sell them, this gain is unrealized. It's like having a winning lottery ticket, but not yet cashing it in. The value is there, but it's not in your pocket. This contrasts with realized gains, which are taxed when you sell the asset and actually pocket the profit. So why does this matter? Well, for the wealthy, these unrealized gains can stack up to billions of dollars. They possess assets that can appreciate significantly over time, yet they pay little to no tax on these gains until they sell, which they might never do. Currently, the tax system only taxes capital gains when they are realized, i.e., when the assets are sold. This approach disproportionately benefits the wealthy, who can leverage their accumulated unrealized gains to fund lifestyles, make investments, and even borrow money, all without selling their assets. You're probably wondering, how does this work? Let's take Jeff Bezos, for example. His net worth has ballooned primarily due to his stock holdings in Amazon. As long as he doesn't sell those stocks, he doesn't pay taxes on his unrealized gains. Yet, he can live extravagantly, borrowing against his stock holdings, which banks happily allow because of the underlying asset's value. This scenario not only lets him defer taxes, but in some cases, pass on his wealth to heirs at a stepped-up value, thereby avoiding taxes altogether. Data from the IRS indicates that the wealthiest 1% own more than 50% of the country's total assets. However, their effective tax rates are far lower than those of middle-class families. This leads to a significant gap in tax revenues and perpetuates wealth inequality, an issue that continues to grow. Now, let's move to the arguments against taxing unrealized capital gains. Opponents argue that it could lead to economic inefficiencies. They claim it would penalize investment and innovation, the very engines of economic growth. They also raise concerns about administrative complexity. How do you accurately value assets that aren't publicly traded? Moreover, there's the risk of double taxation if assets are taxed when unrealized, and then again when realized. Consider the words of Charles Schwab, an influential financial expert. Taxing unrealized gains is akin to taxing on potential future earnings. It creates uncertainty and complicates financial planning for individuals and businesses alike. Another fear is that this could dissuade people from holding onto their assets, leading to market volatility. Imagine a scenario where people rush to sell their assets to avoid annual taxes on unrealized gains. The resulting market instability could have far-reaching consequences. Rebuttal to opposition arguments. But are these concerns valid? Let's debunk some of these arguments. Firstly, the notion that taxing unrealized gains would deter investment isn't backed by evidence. Countries like Norway have successfully implemented such taxes without stifling economic growth. According to a study by the Norwegian School of Economics, the capital investment rate remains stable even after the tax implementation. Regarding administrative complexity, there are technological solutions already being tested. Using blockchain and advanced valuation algorithms, financial institutions can accurately assess the value of assets, making it feasible to tax unrealized gains accurately and fairly. As for the risk of double taxation, tax policies can be designed to count the taxed unrealized value against the realized gains, ensuring no one is unfairly taxed twice on the same income. Essentially, a system could be put in place to credit the already taxed unrealized gains, preventing any double tax scenario. Economic and social benefits of taxing unrealized capital gains. So, if objections can be addressed, what are the benefits? Taxing unrealized gains could significantly bridge the wealth gap, ensuring a more equitable society. According to a recent report by the Congressional Budget Office, taxing just the top 1% on their unrealized gains could generate an additional $750 billion in revenue over the next decade. These funds could be channeled toward essential public services like healthcare, education, and infrastructure. Imagine better schools, more accessible healthcare, and improved public transportation, all funded by a fairer tax system. Moreover, this approach promotes fairness. Everyone benefits from the society they live in: roads, schools, public services. Shouldn't everyone contribute fairly, based on their actual wealth, rather than just their cash flow? You might be thinking, this all sounds good in theory, but can it be done? The short answer is yes. Various proposals offer workable solutions. For instance, annual asset valuations could be done using third-party auditors or automated valuation models, ensuring transparency and accuracy. Implementing this tax would indeed be complex, but far from impossible. Advances in technology can streamline the process. Consider how automated tax filings have made income tax simpler. A similar approach could be adopted here, making the tax system more intuitive and efficient. Governments can also learn from other countries with similar policies. For example, Switzerland has a wealth tax that includes components of unrealized gains, and it runs smoothly, contributing to public coffers without stifling the economy. Why the argument against falls flat? To wrap things up, the argument against taxing unrealized capital gains is riddled with misconceptions and exaggerations. By separating fact from fiction, we see that taxing these gains is not only feasible, but also necessary for promoting a fairer society. The current system benefits the wealthy disproportionately, while most of us bear the tax burden. By adopting a more equitable tax policy, we can ensure that everyone contributes their fair share, helping to bridge the wealth gap and fund essential services. So, next time you hear arguments against taxing unrealized capital gains, remember the facts we've discussed today. And don't just take my word for it. Dig deeper, engage with policymakers, and make your voice heard. After all, a fairer society benefits us all. Thank you for watching. If you found this video informative, please consider subscribing, liking, and sharing it with others. Let's keep the conversation going.